Good afternoon, everyone. My name is Allan Francis with Level Set, and we're excited today to have the material price panel that we're going to have with two really great economists that have joined us to answer some of your questions and give us some of their insight to the entire pricing avenue of what's going on today in the world. And we're going to introduce them really quickly. First, I'm going to say a little bit about myself. My name is Allan Francis. I'm with Level Set. Next slide, please. And just wanted to make you aware that we are here to try to help you get paid, and that's what Level Set's all about. I've been a credit manager for about 30 years, and we just provide the opportunity to get people paid, and that's what Level Set is all about. Now I'm going to turn it over to Alex, if he'd introduce himself.
Thank you. Thank you very much, Allan. Yes, I'm Alex Carrick, and I'm the Chief Economist for the company Construct Connect, and I have been doing this for a long time. At one point, well, early in my career, I worked for the Canadian Institute of Steel Construction for 13 years, and then I've been with various versions of the company that I'm with now for 37 years. So if you add those two together, you come up with a figure that's, and in fact, I was thinking about this, Ken, that you and I, if you add the two of us together, we're a century's worth of I don't know what. Anyway, so
that sounds great.
I'll turn it over to Ken.
Well, thanks, I guess. I'm Ken Simonson. I'm the Chief Economist for the Associated General Contractors of America and have been for 21 years. So I'm a rookie compared to Alex in this industry. I expect most of you know AGC is the leading national construction trade association for contractors and suppliers of goods, services, and equipment in the U.S. We operate through a network of 89 local and state chapters. So I hope all of you are either members or in some way involved with your local chapter and with AGC of America. You can find out more about us at agc.org.
That sounds fantastic, gentlemen. Thank you very much. Wanted to give you guys a few directions. If you have any questions at all, you'll see the chat feature. Feel more than free to put your questions in there. And as we move along, we will be answering as many of those as we possibly can towards the end of our segment. But we're going to go ahead and start with a few questions just for some discussion and get some insight from both Alex and Ken. Once again, really happy to have them here. So with the volatility of the markets, especially supply chain management with materials and everything else, everything seems to be, since COVID, a little bit haywire. And I wanted to ask both you gentlemen to give us your opinions on what is impacting the material prices the most at this time.
Okay, well, there's really quite a number of factors. The pandemic certainly had an influence because heading into the pandemic, the expectation, for example, was that housing would really deteriorate. The housing starts would fall back a lot, and that's one of the reasons that, or that's a reason that a lot of sawmills were closed, for example, and then housing stayed much stronger than expected. So the price of lumber took off, and the price of lumber, everybody knows about how it went up by 100%. So it's that kind of thing that's impacted the marketplace across a number of building materials. And then, of course, the conflict in Ukraine, with Russia threatening to cut off supplies of natural gas and oil, and the uncertainty about pricing there caused fossil fuel prices to really increase dramatically. And that's that's had a lot of knock-on effects in terms of agricultural prices. And it also seemed to lead a lot of other commodity prices higher. So that's been a factor. And then also China really hasn't dealt with the coronavirus crisis very well. The government there has shut down ports whenever they come across even a small number of cases. And so the cost of moving goods across the Pacific by container ships, the cost of that has increased tenfold. And there's other things that have impacted it as well. So So what we've had really is, and one of the things that we do at Construct Connect, which by the way is a leading provider of information on construction projects. That's what we do. We've got millions of projects in various stages in our database. But at our corporate site, we have graphs showing, and actually, Alan, you can go to the next slide, I think.
Okay, we'll move on to the next slide. Okay.
Well, the one after that, maybe the one after that shows just an example of what we've got. So yeah, so at our site, we put up graphs for 35 building inputs, and almost all of them have spiked, and it's things that you wouldn't normally expect. I mean, for a while there, even cement was up, and flat glass was up, and then construction equipment and heating equipment and cooling equipment. So it's been very widely distributed. There's been spikes in almost all 35 of these inputs into construction. Now there's signs of it easing. So if you go back one slide, you'll see that the input price index has been coming down, and the bid price index has been going up. And I think Ken wants to say more about that. So I'll turn it over to Ken.
All right, thanks, Alec. Yeah, the red line here is a compilation by the Bureau of Labor Statistics. It's a weighted average of all of the inputs to new non-residential construction. The blue line is what I call a bid price index. The Bureau of Labor Statistics calls it the producer price index for new non-residential building construction. And they create this by asking a fixed group of contractors each month, what would you charge to put up a particular building? And they're asking probably several hundred contractors, they don't reveal how many exactly, about different buildings, but each contractor is asked about the same building it was asked about the month and the year before. So I think it's as close as we can come as the usual process of asking, say, a gasoline retailer, what did you charge for 87 octane regular gas? Or a widget manufacturer, what was your price for an A321 widget on September, or this would have been the latest here is July 11th. They do ask about a particular date. At any rate, back in September 2020, both the input costs and the bid prices were going up at a very moderate 1.8% year-over-year rate. And then, as Alex said, tons of inputs started going up like crazy. Partly because of the shutdowns from COVID, both U.S. production and, of course, the surge of imports meant that the ports on the West Coast were backed up with as many as 100 ships waiting to unload. There weren't enough longshore workers or rail workers or truck drivers to deliver the goods to their next point and so forth. So many things started that upward trend, and then it continued with the freeze in Texas that shut off the supply of many construction plastics for a while, blockage of the Suez Canal, a lot of one-off events that both disrupted supply chains, drove prices up. And in fact, we had 12 straight months where that weighted average of all of the inputs was rising at a year-over-year rate of 20% or more. Just in the last few months, things have started to calm down, and tomorrow we'll be getting the August figure. And while I don't usually stick my neck out and predict what a given index will look like a month out, or the day out, because there are always a lot of special factors and often revisions to the base period that you're comparing to, I do think that we will continue to see this downward trend, because we know that fuel prices have come down quite sharply in the last month. Steel prices, at least at the production level, the hot rolled coil price, has continued to work its way down. And for a while, we also saw declines in other metals. Not everything is going down, though. A month ago, I was seeing dear valued customer letters or announcements from gypsum producers, and there are only 4 major producers in the US, that they were going to be raising their prices very sharply in August or September. And cement makers have been warning that ready mix prices will be going up again, though perhaps not till January. So it's a mixed story now. But meanwhile, the bid price finally has started climbing. The contractors have seen a lot more work, that owners have shown willingness to accept the bids with higher input prices. And so for now, contractors seem to be catching up. But that whole expanse between the red and blue lines before the lines crossed pretty much represents costs that contractors had to absorb. So it has been a tough time for many contractors.
Well, I tell you what, this as a credit manager, all that information gives a real perspective on things that we've been looking at. And sometimes the sky looks like it's falling, but the perspective that both you, Alex and Ken, are giving us is I guess it's not reason for panic at this point. But our next question will lead into that. How do you see material prices changing? And we're asking you to look kind of into your crystal ball over the next 6, 12, and 24 months. That's way out there.
Yeah.
But would just like to get, Alex, we'll start with you. What do you think?
Well, I think the next 6 and 12 months, the outlook is for moderation in prices, because there's a slowdown underway in the economy, and I know we're going to get into the question about a possible recession later on. But the increases in interest rates, just a second, sorry here. The increase in the interest rates, clearly there's reasons to think that the economy overall is slowing down, but there's other things, and prices, a lot of the prices are moderating, just as a natural fallback, like housing starts are not holding up as well as they were, and so on. I think in the short term that we're going to see some easing in the difficulty that everybody's been having. But what I tend to say when I'm out talking to people is inflation is one thing. What you've got to be aware of in terms of your business is that over the longer term, I can't see how it isn't going to be a world in which simply living and conducting business isn't going to be a whole lot more expensive than it was in the past. And that's because there's so much more that's happening now than there used to be. I mean, companies have to deal with ethics questions, for example. They've got to have compliance courses. There's this big push on for net zero emissions. And so companies are going to, if you've got a fleet of cars, you're going to be buying electric cars, and they're more expensive now. And if you're an aluminum manufacturer or a cement manufacturer or a steel manufacturer, you've got to change your processes, and you're going to be spending money on other systems than simply expanding capacity. You're going to be trying to cut down on carbon emissions. And so there aren't going to be the increases to capacity that used to be the answer to inflation. So I'm very much inclined to think that there will be a next commodity price super cycle, and that will have quite the impact on prices over the long term. Now, on the other hand, there's things like there's some new big steel mills that'll be coming on that'll be increasing capacity. And there's whole new industries that are being set up and so on. But that's the impression. I think everybody should be aware that inflation or not, everything's going to become more expensive. And we're supposed to be talking about materials, but there's been a big shift has happened in terms of labor too. Like the whole move towards deglobalization has changed the balance of power between labor and management. So it's no surprise whatsoever that you see things like the talk about a strike in the rail industry, that's where they say that maybe that'll start on Friday, because labor can now flex its muscles. There's a shortage of workers, and it used to always be the threat that if you didn't like your job, your employer was going to send your job overseas. Well, that's If you reverse that situation and you bring the jobs home, there's a lot to like about that, but you got to know that that changes the dynamics and management labor relations.
Okay. Well, I appreciate your looking into the future for us. Ken, can you give us your outlook?
Yeah, well, I largely agree with Alex that I do think we'll see moderation in some materials costs for a variety of reasons, partly an economic slowdown, particularly in the housing sector that will free up a lot of lumber, gypsum, some other products that are used in non-residential and multifamily construction. Second, we're getting selective increases in supply. As Alex mentioned, 2 big new steel mills are under construction, some fab plants or steel fabricators, and also the fab plants for semiconductors that will certainly make a difference over the next couple of years as they come on stream in availability of chips, whether for vehicles, for construction equipment, for smart tools, for consumer items. So that will be helpful. But we will also see new demands as we need perhaps hundreds of thousands of battery charging stations and the materials that go into those, more materials needed for offshore wind, solar projects, a variety of infrastructure projects, and so forth. So I think we'll see a mixed picture, but generally a downward trend on materials cost increases. That is, if that index that I showed, the red line, continues to be rising on a year-over-year basis, it'll be by single digits, not by double digits. But I also agree with Alex that the biggest worry for contractors and the most persistent one will be finding enough labor and getting that labor up to an adequate skill level. So I think that owners can expect projects are going to take longer, probably take longer to launch, just because there are going to be, particularly with federally funded projects or ones supported by tax credits or other federal incentives, there are going to be a lot of strings attached, almost hawser-sized ropes, you might say. And it will take a while to see what the rules are for those and whether you can even come up with US-made materials or labor, the right number of apprentices, many other restrictions on how to use that money. So these things are going to slow down projects, in some cases dramatically push up the cost of finishing a project. And so owners do need to pay attention to much more than strictly the price of steel or lumber or diesel fuel.
Boy, these were great answers. And I tell you what, we're seeing it firsthand where I've never seen it in 30 years where lead times have become such an issue and where multiple projects at one time that we oversee are missing their final deadlines or missing their material supply deadlines, and actually their completion dates are being missed by 6 to 12, 13, 14 months. It's really, all these things obviously are playing into it. So that really helps the information they're giving us. So let's move on to this next question. And this is the $1 million question. Is there a recession on the horizon? And if so, or if not, what does this mean for the construction business? I think you've all kind of touched on it a little bit. Ken, I'm going to ask you to start with this one. Give us your insight.
All right. Well, I can't say I have insight. I don't carry a crystal ball, but I will tell you my bias that I'm an incurable optimist. And in this setting, I don't think that we're in recession. There are a fair number of economists and others who believe we are. And I think that we'll escape without a recession. Now, that's keeping my fingers crossed on both hands. But in any case, I think the implication for construction of a slowdown, and there's no denying that we're heading to a slowdown, or we're already seeing signs of it. We mentioned housing already being in a slowdown. I think we're going to get a rotation that some of the stronger segments of construction spending in the last couple of years, warehouse has been a real standout, data centers, and a few other niches. But now I think any business that depends on getting immediate income to pay the costs of construction and the financing is vulnerable to this slowdown / recession. So I'm thinking of apartments, warehouse, office buildings, multi-tenant office buildings, retail, restaurants, and certainly hotels. All of those, the developer, the owner has to be looking to can they charge enough rent or hotel room rate in order to cover the rising costs of materials and of financing. And with the Fed seeming sure to stay on a course of raising that interest rate target each time they meet, financing costs are going to go up fairly sharply. But other types of construction are about to come into the limelight. So we had the Infrastructure Investment and Jobs Act signed a year ago by President Biden. And I think some people probably thought, oh, an immediate boom for many types of infrastructure. Not so. It takes quite a while for that money to filter through not just the different agencies, but to meet the new requirements. I talked a little about that with the new regulatory requirements. And then state agencies or local agencies for some kinds of infrastructure, they have to go through their advertising and bid opening process. So I think it'll be a 2023 story before we get a pickup in many of the infrastructure categories. Now, we've already seen quite a pickup in many kinds of manufacturing. Some plants already underway, like the steel mills, the aluminum rolling mill in Alabama, the fabs. But we've also seen announcements practically every week of gigantic plants, giga projects as gigafactories or mega projects as Alex tabulates them, that are showing up in many states and many types of manufacturing. And then third, the power and energy sector, I think, will also be growing quite strongly. And all three of these, infrastructure, manufacturing, power, and energy, fortunately, they're less affected by short-term interest rate hikes or even a short, mild recession because those projects are being built for 20 or 30 or 60 years out, and the financing doesn't necessarily come from borrowing. It's from taxpayers, from ratepayers for utilities, from manufacturers' own cash flow. So I'm optimistic, as I said, but I do see the industry turning.
Okay, and before Alex jumps on, I want to remind everybody this is interactive. If you have questions you'd like to ask either of our experts, feel more than free to type those in the chat section, and then we'll get to those during the last 5 minutes of our webinar today. So Alex, I'm going to have you jump in and give us a little bit of your insight to what you think about the recession or whether is or is not going to be one.
The question of whether there will be a recession, you see, I don't really think of it as a huge concern. I've got a whole story here about what I think is going on longer term. I think we're at a watershed moment, and if you can just follow me down this path, it leads to some really interesting conclusions about construction. And this relates to the IIJA, the Infrastructure Bill, and the Inflation Reduction Act, and the CHIPS Act. And I think they're really kind of a watershed moment in two ways. One, the US is now serious about confronting climate change. And regardless of the Paris Accord and whatever theme they've come up with there, the real theme around the world is net zero emissions by the middle of the century. And that's not very far away. And this is actually really happening now because the car companies are totally committed to having electric vehicles as a major part of what they sell by 2030, and even getting out of internal combustion engines by 2035. And so if you think about NZE by 2050, or mid-century, trying to end SETI by mid-century. That has huge implications for the kinds of commodities that are going to be developed and needed, like aluminum and copper, like you need copper to transmit energy, to transmit electricity. And the major answer to achieving that goal is to have an awful lot more electric power generation, so electrification. And that means renewable energy projects, and maybe even nuclear. Nuclear is somewhat coming back into favor. And it means new industries too. It means things like carbon and capture facilities. And it means hydrogen, new hydrogen plants. And we're seeing it in terms of what the auto sector is doing and so on. And then the other, so that's one major stream that follows from these bills is climate friendly construction. And then the other major stream that follows from all of this is that the US is starting to think strategically. And this is really interesting because there's a recognition that batteries, EV batteries, most of those now, 70% of EV batteries in the world come from China. And the chip bill is an effort to bring production away from a geopolitically sensitive area back to the United States. So that's one strategic thinking. And then so that's battery plants. That's, sorry if I said chip, but the chip making is also thinking strategically because the chip manufacturing has been happening overseas as well. So you got the strategic thinking that is bringing battery production home, that is bringing chip making home. And the way this flows and why this is important for construction is that there have already been a tremendous number of huge mega construction projects that have been announced. In the area of chip making, there are $10 billion, $20 billion plants going up in Arizona, likely to go up in Ohio, and there's a number of others. And it's the same with the battery plants, and it's the same with new investments in car making plants for electric vehicles. And then there's new industries like hydrogen and carbon capture and storage. And these are very large projects. So even this year, the dollar volume of mega projects is $60 billion through July. And that's about what you would expect in any given full year. So it's the mega projects and it's the new industries and so on that I think are going to be, and all of this, again, circles back to a need for a different kind of commodities than in the past, like lithium and so on. In fact, Tesla the other day announced that it's thinking of building a big lithium refinery in Texas. So that's what I think about recession. I think it's certainly possible that we could talk ourselves into a recession. And the Fed seems, I'm worried that the Fed may over-tighten. The Fed came into a lot of criticism for being very slow to react at the front end of the inflation story. And there's a danger that they might try to be too tough, to talk too tough, and perhaps tighten up too much. The other thing that the US that concerns me is population growth in the United States, because an awful lot of the economy depends on having strong population growth, and the US is not there anymore. So that has implications. But in terms of the whole picture, I'm very optimistic. I'm very optimistic.
Very good. Well, I appreciate your input on that. Ken, did you want to address another issue?
Well, I had a little more to say about where construction is headed. The next slide shows 3 forward-looking indicators. And so while I don't have a crystal ball, I do look at what other people say they are hearing. The Architecture Billings Index is put together by the American Institute of Architects. They ask several hundred architecture firms each month, were your billings higher or lower than the month before? And to the extent that more firms say higher than lower, they put this index value above 50. Well, it's been above 50 for 18 straight months through July. And AIA says that this indicates construction spending on new non-residential buildings will be increasing 9 to 12 months after the index goes above 50. So a very favorable indicator for continued growth in non-residential building construction. Hope Alex will forgive me for mentioning this other firm that puts out a momentum index. They look through their database of projects that about a year away from starting, and they create an index number that you can see has been rising considerably from its year ago value. And it's been signaling growth for both commercial and institutional projects. And then the Census Bureau each month reports on single and multifamily projects or units that have broken ground, that are under construction, ones that have permits taken out, but not, and then permits that have not yet turned into starts. So this is kind of a backlog index for multifamily, and it looks very favorable. It's grown 47% from July of last year to July of this year. But I have to say that in an environment where interest rates are rising fast, construction costs are going up, while a little less than a few months ago, still going up faster than the overall rate of inflation, and therefore probably faster than they can raise rents, these permits may never turn into starts. There's nothing automatic about it. So this is the one I have the least faith in. Nevertheless, I do think overall we have a favorable environment for further construction growth.
Well, I tell you what, all that information to me it looks positive. It really does. And what we're looking at next as we get to this question, you've kind of already looked at it and actually discussed it a little bit. Do you all have, Ken, do you have anything on this slide that you'd like to discuss? What kind of impact will the infrastructure bill have? The chips and this.
Well, all three of these bills, as Alex and I have mentioned, should have a positive impact on demand for projects, but executing will be difficult. First of all, as I said, for a number of reasons, the money itself will take a while to get out there, that there are a lot of new strings attached, but then also to the extent that these projects are competing with each other. If you have a bunch of electric vehicle plants going up at the same time, you're going to need the same kind of workers in all of those locations. And we're already seeing a real shortage of available workers. AGC does a survey every year on worker issues, and we just released this immediately before Labor Day a couple of weeks ago. 93% of firms said that they were looking for hourly craft workers. Of those, 91% said that positions were hard to fill. And that was a little bit higher than in previous years. It's a longstanding problem. What has changed is that 70% of firms said that they were having trouble or that they had openings for salaried positions, and 89% of those firms said salaried positions were hard to fill also. So I think this is going to be a persistent problem. As Alec mentioned, we've seen a huge drop in the US population growth rate, and that includes a huge drop in immigration. That affects construction more than other industries, because construction has historically relied much more than other industries on foreign-born workers. So unless we can increase the willingness of students, of parents and guidance counselors to tell students about opportunity in construction and get more people to choose that as a career, unless we can open the doors more to employment-based immigration, for needed workers who can't be found here, the industry is really going to be struggling. There is an extent to which they can go to off-site production, assuming those factories can find the workers with the right skills. Certainly firms are adopting more and more on-site technology, whether it's drones or 3D printers, robots, virtual and augmented reality devices, better scheduling so they don't have workers standing around waiting for materials to come. Lots of little incremental changes, but none of it will be enough to wipe out this skilled labor shortage.
And very good, Ken. And before I get back to you, Alex, one thing I noticed anecdotally, that's something I have to ask as a credit manager for each project that I approve that I never used to have to ask is, how many total employees are you depending on to fulfill these projects that you have in the pipeline? That's never been something we ever had to ask for, but sometimes these subcontractors that want to bite off more than they can chew will accept 10 projects and only have 3 employees. And it's a night, we're actually doing them a disservice sometimes by approving the contract and approving the material financing. So that's really good information that you're giving there. Alex, did you want to add some things to this as well?
Well, I have a standard story about commodities, because commodities, everybody wonders why I go on and on about commodities and commodity prices and so on. Commodities are the basic building product that goes into everything. They're basic building blocks for everything, really. I mean, oil and gas go into asphalt, and they go into plastics and so on. And copper goes into plumbing and the like. And so if there's increases in commodity prices, and really not an awful lot of new capacity has come up in terms of copper and some other materials, base metals and so on, that's going to add to construction costs. But there's a flip side to this. I always like to emphasize that there's a flip side. Because if the price goes up, that's an incentive for owners who own extraction sites to go ahead with projects. And so we're already seeing that there's a lot of money that's being spent on petrochemical plants and even gold mines in some parts of the world and so on. So higher commodity prices can be positive for construction, and certainly the price of lithium has taken off, and there's going to be new lithium mines, lithium processing facilities, and so on. So that's something on the commodity side to always be aware of. And in terms of jobs and job availability, construction's having trouble finding the workers, and immigration was always a source before. And that's not as readily available as it was. But contractors are going to have to be aware, as I'm sure they are really, that there's all kinds of new jobs that are going to be opening up in other areas, like people, the young adults getting their education. They're going to have opportunities to work in things like artificial intelligence, and setting up businesses in the metaverse and so on, whatever the heck that is, and doing blockchain and doing a whole bunch of stuff that was never an option before. And so it's going to take some real dance and lively to find the things that are going to attract young people into the industry. Now, this also has implications in an interesting way, because everything impacts everything else. It also means that the universities and colleges are going to have to change their courses. And I know that they're already doing things like offering courses on logistics. That was something that when I was growing up, you never had courses on logistics, for example, or designing drones, or designing climate-friendly projects, that sort of thing. So universities and colleges, and frankly, that might help to save them, because with so many people taking courses over the internet, the outlook for construction at colleges and universities wasn't looking that great. But that may be one of the things that helps to maintain activity levels, capital spending levels at higher education. The levels of lower education, that depends on a stream of people going into the lower grades, and that's impacted by immigration and the slowdown in population growth. So that's maybe not looking as optimistic. But those are my comments on
Well, great.
commodity prices and skills availability.
That answers those questions very well. You know, we were going to hold some of the questions till the end, but one that this fits right in. We have a question from the group. How can we find more information on how this infrastructure bill is being allocated or dispersed? I don't know if that's something you both are aware of, or if you'd like to speak to. Ken, you're muted at this point.
Sorry,
Sorry.
From AGC's standpoint, we certainly have some materials about the act and what the provisions are. We have a lobbyist who follows closely both what Congress has done, what DOT is putting out, and the other agencies. We have several specialists on different agencies such as US DOT, the Environmental Protection Agency, and others that get tranches of this money. So I would be glad to take a question by email and forward it to our subject matter experts. And I think we'll have a slide at the end on how to contact me, but I'll just say it out loud now: ken.simonson@agc.org, or go to agc.org and see the free material on our website. But I know that Alex's firm actually tracks projects at various stages. So you may have something that specifically tracks the IIJA.
Yeah, Alex, you had spoken to that a little bit. They just want to know where they can go to find more information about how this money is being allocated for infrastructure bill and how it's going to be dispersed. Do you have anything you want to say to that?
Well, it would depend on the location you're in, and of course, getting onto the website and looking at specific budgets for municipalities and for your state and so on. We have Construct Connect has an inventory of all projects in the planning stage and so on. That's actually a good point. We should probably see if we can specify or come up with a report that is specifically tied to the IIJA. I'll ask. I'll pass that on to our research people. But we have information on almost any construction project that is publicly known out there at a very early stage, contemplated, proposed, preparing plans, and all that sort of stuff.
What's your website, Alex, or is that available for us later?
Well, it's just www.constructconnect.com. Construct Connect. Yeah.
Okay. Thank you very much. I believe we have one more slide with questions, and then I've got another question from the gallery. Okay. So how can contractors stay most up to date on the latest prices and economic trends to stay prepared? I think we've touched on that throughout this, but would really like to hear from both of you on this. Ken, did you want to start with that?
Sure. I write a weekly one-page summary of economic news relevant to construction called the Data Digest, and I'd be glad to add people to the email list if they just want to email me, again, at ken.simonson@agc.org. Tomorrow, for instance, I mentioned the Bureau of Labor Statistics will put out producer price indexes for August. So I'll be discussing the latest trends in that, along with other recent data. And I append or link to a set of tables that show how about 60 of those PPIs have changed in the latest month, 3 months, and 12 months, and also give historical data on those. Likewise, I have a full set of slides that I update frequently, and would be glad to send those along. And then third, AGC for the last year and a half has been putting out what we call the Construction Inflation Alert, which is an 8-page document written in hopefully plain enough English and clear enough slides that, or graphs that you can use it to help owners, officials, media, and others understand what's been going on with materials costs, supply chain issues, labor availability, what it means for contractors. Very
good. And Alex?
Well, it's the standard thing that most people are doing anyway, networking. And, and the other thing is the way I just read a lot. I subscribe to I subscribe to all kinds of things, and I do an awful lot of reading, and I do research that way. In terms of the PPI, you saw the graphs earlier. We do at Construct Connect, we have an economics choice there, and you can go and we update 35 graphs on 35 materials, and then we also have a table on other materials that are reported on by the Bureau of Labor Statistics. The other thing that I guess I would, there's two other things. I would suggest, and people laugh when I say this, but in the old days, anybody ever asked me about what a career would be, I would say computer programming. That would be the growth career that for sure was, if you got into that, you were going to be fine. I think the future world that we're coming into, and we're actually living in the future now. I mean, that's something to consider. Where when I was growing up, the science fiction, we're living in that science fiction world. But I would say, know your chemistry. Know your chemistry. I hated chemistry. I hated chemistry in high school, and I wish I'd paid more attention. But everything now depends on chemistry, because it's alloys that go into the making of steel and aluminum and so on to make them lighter and stronger. And then where are these chemicals coming from? Like what parts of the world are they coming from? So that's something. And then also pay attention to regional developments. Like, I can't believe it. I follow the labor statistics pretty thoroughly, and if you start to look at them, you just wouldn't believe how strong the Texas and Florida economies are. 3 of the 4 major cities in Texas are in the top 4 among all 50 cities in the United States for year-over-year employment growth right now. And all 4 cities in Florida are in the top 10 for lowest unemployment rates. So the population's shifting around the country, and it's moving in from the West Coast because they got fires and stuff going on there. And it's that kind of thing. And there's certain parts of the country like Nashville and Atlanta and Phoenix. There are certain cities that always show up as being very, very strong centers of economic activity. And then finally, my final point would be, if you can follow, you can follow me on social media if you like. And I have what I think is an interesting approach to LinkedIn. I treat LinkedIn every day. I post at least 2 slides on LinkedIn that are graphs about what's going on in the economy. And I'll have a little explanatory box. And basically, and I know that there's many of you out there who just love PowerPoint presentations. And basically, I treat LinkedIn as a never-ending PowerPoint presentation. So if that's your if that's your thing, go on there and find Alex Carrick, and every day I've got at least two graphics up there.
Well, that sounds fantastic, gentlemen. I really appreciated your time, and we're just about to wrap things up. We did have another question that kind of tied into number 5. And before we get to these last few slides, how can we as a construction company be strategic as we move into this new era, tech-driven society? So kind of everything we talked about in 5, but just this little, the tech-driven society, this new era, how can a business, in as few amount of words as you can give me, how can they be strategic moving into this new era?
I wish I could give it in a few words, but
okay, well, you can take as many words as you want. We're up against a hard deadline in about 9 minutes. So
right. No, I would just say that it really depends on what you think your own strengths are in terms of your ability as a manager or an executive of a construction firm, how good are you at identifying trends in your market? What are the strengths of your company, of your suppliers, or sub contractors, and then try to keep an eye on that customer base and what's likely to be affecting them. So I know that that's a terribly general answer, but the other thing I'd add is, as Alex said, technology really is changing so many things. And for construction, I think it's really important to be exploring ways in which you can either make do with less labor or labor that doesn't have the same skill set as the people that are retiring or leaving, or that you may have been used to hiring or getting out of the union hall. That I know it's traditional for people of our age, Alec and Allan, me, to talk about the terrible work attitude and lack of preparation of the young. But in our survey, we found that the respondents found that people really did have a lot of technical knowledge, or at least a large percentage of them did, and those were things that interested them. And so to the extent that your company can make construction work appear to be more technological, and you emphasize that you do get to play with cool tools, and the company is open to new ways of doing things, I think that's going to be a key to success, to attracting and retaining workers.
Very good. Alex, did you want to jump in?
Well, yeah, the thing that's on everybody's mind right now is inflation, and this isn't particularly strategic or anything, but inflation has been worse. I mean, back in the early 80s, inflation was 14%, and the federal funds rate was 20%. And the way that companies handled it, because I lived through that, I remember how bad that was. I had a mortgage that was coming due, and I was quaking in my boots. But we survived it. And companies, the way they got through it was they came up with innovative ideas, and part of that was cost of living clauses in their agreements with their labor, and then also escalation clauses with owners and so on. So I know that companies are already thinking of these sort of things, but it's staying lively, coming up with innovative ideas and so on. And as I say, just continuing to research. And there's things like podcasts now. You can go online, and there are technology. There are podcasts that relate specifically to new technological things that are happening within construction. And you can get some ideas there.
Well, thank you, gentlemen. This has been very, very informative, and I've had a good time because it hasn't been all gloom and doom. You've given us some hope and some light at the end of the tunnel, and we've got a few more slides. If there's anything you all want to say to these that give you some resources, the AGC, et cetera, that you all want to speak to, and then I'll wrap up with Level Set and everything that we do, and then we're going to be done for the day. Wanted to let everybody know you will be, if you signed up to see this or to be a part of this webinar, you'll be getting a copy of that, and it'll be going out to your email sometime in the next 24 to 48 hours. That's what I've been told, so I'm hoping I was right in saying that. So AGC Economic Resources, anybody want to say anything to this?
I think I've done enough self-promotion at this point. I just add one more time my email. If you want to email me directly, is ken.simonson@agc.org. Thanks very much for having me.
Well, I tell you what, Ken, it's been a pleasure getting to know you. Alex, the same. Your insight has been amazing. And I tell you what, I couldn't be happier to have the privilege to be a part of this webinar today. Let's go to the next slide. And then Level Set. So just to make sure we're paying the bills, my name is Allan Francis with Level Set. We have a lot of different products that we offer to help. A lot of them are free if you just go to our website at www.levelset.com. We have the Level Set Material Price Tracker that you see off to the right there. We have Level Set Construction Financial News, Level Set Legal and Credit Community. All that you can find at our website, and just a whole load of information to help any small construction business to large construction business to get an edge and be a part and get themselves paid, and to be on that cutting edge of growth is what we want to help you do. And then finally, Level Set Materials Finance, a thing that I'm a part of. banks are tightening up their wallets and they don't want to do business with anybody unless it's a sure thing. And we come in to help the little guy and to help the big guy expand how much power and capital their money can buy for them, and to be able to take their credit lines and expand them and provide the opportunity to finance their materials and have 120 days to pay it back, or whenever their GC pays it back, so it doesn't put them up against the wall to these completely unreasonable this time of in the economy of 14-day terms, 30-day terms. This gives those contractors 120 days to take care of paying what they need to pay, and the materials are supplied for them, being able to give them some opportunities to get some discounts and other things. So all that's available to you. You can check it out on our website. If there's nothing else, it has been a pleasure to have all of you today. If there's any other questions, please feel more than free to email us or Slack us that information, for those of you that do have Slack or Microsoft. Here's our QR code that you have. And once again, I want to thank everyone for their participation and hope you have a great Tuesday afternoon.
Thank you very much. That was fun.
Thank you.
That was great.
Bye-bye.